So much. Let's continue that conversation on the global economy and what that tariff story actually looks like. William Lee, Milken Institute chief economist, joins us now. Bill, pleasure to have you on the program. We were just listening to Brendan about why this time may actually be different than last time in the ways that it shows up, but the consensus seems to be the same from most of the economic community. The idea that tariffs, these non-tariff levies, this kind of deglobalization will ultimately be inflationary and a pain for the American consumer. Do you agree?
No, I don't, actually. I think the natural reaction for most economists is that the minute you talk about tariffs, there's this natural disgust and say, oh, my God, it's going to be the end of the world. I think this time we have to realize that President Trump is approaching tariffs very differently than he did before. In his first administration, he was talking about bilateral trade deficits and in his first administration, he was talking about bilateral trade deficits and trying to get the trade imbalances in order. And now I think he sees that the tariffs are a very powerful tool for inducing people to come to the bargaining table and be serious about things. So he put on tariffs to our closest trading partners, Mexico and Canada, and talked about steel and aluminum, and said, look, we need you to help shut down the border. We want you to cut down the illegal immigration that's coming through and the illicit drugs that are coming through. And let's deal with the issues that we have at hand. And yes, I want to produce more steel and aluminum in the United States, but I'm going to do it by encouraging global investment. When he was at Davos, he gave a talk that essentially invited every CEO around the world to invest in the United States. He's telling everyone the United States is a great place to invest. The return is highest here. And let's invest in the sectors that we think are really important, and we're going to help you do it. And we're going to give you a tariff barrier to protect your investments here. So if you want to compete with us and produce steel and aluminum abroad, you're going to face a 25% tariff. But if you come here and produce, not only are you going to avoid the tariff, but we're going to give you some tax subsidies as well. So we see that Donald Trump is really approaching tariffs in a very different way. It's a negotiating tool to get a lot more done, including foreign policy as well as economic policy.
So, Bill, let me push you on 2 points there. One, starting with the investment front. We've seen this under Joe Biden as well. We certainly saw this in the first Trump administration, where I'm going to give you the example of SoftBank, for example. They've just promised about $100 billion of investment, as high as $500 billion in terms of AI infrastructure. But those promises were made in the first Trump administration as well, but not necessarily executed. What maybe credibility or what assurances do you have from your vantage point that the promises of investment being made will actually be seen through from the companies around the world that are doing so?
Kriti, that's a great point. And I think one of the things that we have to be careful about is it's very easy for CEOs to develop vaporware, right? Just a lot of promises and no execution. And even when they execute only part of what they promise. But what I think President Trump has done in the first administration is to show that he's serious about deregulation. And that is really the biggest barrier to investment in the United States, is the regulatory stuff. It's not interest rates so much, but rather it's the regulations. I think this administration, he's going through a huge change of government. We had an interruption with the Biden administration that put on more regulation and made government a more prominent factor in people's decision making. But now I think President Trump is making very clear he's trying to get rid of the source of that interruption. The source is the bureaucracy. So with DOJ working to reduce the size of the federal government and his anti-regulatory pitch from the first era, I think the CEOs abroad are going to see that he's very serious about providing investors with a platform where returns are the highest and where innovation is encouraged.
So, Bill, I'm going to bring it right back to Joe Biden here, because this idea of attracting investment to the United States, I think, and I agree with you on the idea that there is that more kind of emphasis on regulation under the Biden administration, but there was in every area except for the chip sector. And I put an emphasis on this specifically because we know that the Biden administration under the CHIPS Act gave out basically grants and subsidies to the folks that are going to invest and produce in the United States. Intel really took advantage of that and its stock traded accordingly. Why is this different than that? Is subsidization, are grants more effective or less effective than the approach that Donald Trump is using?
I think the use of grants is a very dangerous way of doing industrial policy because that's essentially the government picking winners and losers. What you want to do is create the environment where rates of return are high, and that's by changing the environment itself. One of the things that people in graduate school learn about is what's called the Lucas paradox. Why is it that capital flows from capital-poor countries like emerging markets into capital-rich countries? It's because capital-rich countries are environments where the returns are the highest. But that's only possible if you get the government out of the way. And I think the Biden administration, that interruption, that 4 years, really, I think, put a dent into the view of that the United States is a source of high rates of return. The subsidies, as I said, is a way of picking winners and losers, and more often than not, governments pick losers rather than winners, including not just the United States, but like Singapore. Singapore was a good example of a country that tried industrial policy through subsidies. It tried to build a competitor to TSMC. It failed. It tried to become a chemical hub, and it failed there. So government's picking is really not the right way to go. You really have to create that environment of less regulation and lower taxes in order to encourage markets to find where the high investment opportunities are.
Bill, I hear you on all of that. It makes me think, and you brought up the Lucas paradox specifically, it makes me wonder, is the era then of friendshoring, of outsourcing over? And can the American consumers, if so, afford for that to be over?
I think what we're seeing is a revision to globalization. We learned the vulnerabilities of globalization during COVID, that you cannot have single sources of vital materials, whether it's pharmaceuticals or masks. One of the things that you have to make sure of is that the stuff that you need in the United States to really bolster national defense, to make life easier here, is to diversify your supply chains. And I think that's really the key to, I think, what's going on now is the use of tariffs is a way of diverting trade, diverting it away from single sources to having multiple sources. And I think the use of trade tariffs is a way of allowing diversification of supply chains. I think that's the thing that I think most economists are ignoring, is that we're trying to correct the distortions that are already there. You just had a segment that talked about the huge number of tariff and non-tariff distortions in trade with Europe. You can argue about how large that amount is, but no one will say that there is no distortion. And so by putting reciprocal tariffs, for example, it's a way of leveling the playing field, or even better, to get people to come to the bargaining table and discuss what needs to be changed in order to have a more effective flow of capital to the right places.
So, Bill, a final question here on the consumer then, because the narrative around all of this is that no matter how good or kind of game-changing this approach is, ultimately the American consumer is going to face the brunt of it. The timing of that might actually be perfect, but I'm curious, in the face of some really strong economic resilience here, what is the straw that breaks the consumer back?
Well, there you had touched on a very, very important point. Something that I've talked on Bloomberg quite a number of times is about the dual America. 60% of the population is living paycheck to paycheck. We have a strong consumer because the people who own assets, stock market assets and pension assets, which is about 20% of the population, they own about 80% of the pension and stock market assets out there. And so that stratification of wealth is really a vulnerability in the U.S. economy that really has to be addressed. And I think the election of Donald Trump was a way of people expressing their discontent that just life is not as good as the aggregate numbers show, and that more and more people are saying, I'm barely making ends meet. Having the kind of industrial policy that he's putting in place with tariffs and diverting and diversifying the supply chains is one way of saying, I'm going to try to improve the employment situation for Americans. The Make America Great agenda is to maximize the income and employment of American residents. And that's really a way of addressing this split and vulnerability in the consumer sector.
Bill Lee of the Milken Institute, we thank you so much for your time, providing us with a little bit of a contrarian perspective, certainly a valuable addition to this morning. Coming up on the program, we're going to talk about several of the factors that Bill just talked about in regards of the Trump administration, this time in the context of the German election. Coming up on the program, sitting down with German Chancellor Scholz on U.S. trade relations. That conversation right after the break. Stick with us. This is Bloomberg.